was for us to look at not only the investments that you're using, the microphones are on, the investments that you're using today, but we also went back as a takeaway and looked at the entire lineup. And we have come today with some additional recommendations across the entire lineup of what we would do. And then we've also included that in the share class analysis so that you can look at that and go through it. In the draft, as Dave went through it and provided some feedback on the fee policy statement, the language that was used in there, and I think it's probably worth discussing, is moving from a pro rata allocation of how fees are paid in your plan. In other words, today they're paid pro rata. As your plan gets revenue share, that revenue share is collected. And then the fees for Prudential that are paid out of that are then allocated pro rata across the accounts or across the plan participants. So those with a bigger balance pay a larger share of the fee. Those with a smaller balance pay a lesser part of the fee. One of the changes suggested that Dave came through us was to change that and move to a per capita fee schedule, which means the revenue share will come in. It would be rebated back to all participants, so only those participants that are paying revenue share, they get it credited back to them. And then you would charge a per capita fee to every participant in the plan. Everybody pays the same regardless of how big their balance size is or not. So either way, from a fiduciary standpoint, is clean and acceptable. The important part of the fee policy statement is it spells out this is how we do it for the plans, and this is how we follow it. So I'll pause there if there's any questions there. I know that was kind of the discussion we had last time, was preference to move to zero revenue share, but given the higher expenses that you end up paying a little bit, and they weren't tremendous, but they were a little bit. They were, I'd say, marginal. And then looking at a per capita.
And my recollection was that if the net cost is less to have some revenue sharing included, then that would be the preferable method.
Yep.
Provided it gets credited back to the specific account of the individual who held that class of investment, created the revenue.
Yep. So under that per capita model that was suggested, that's what would happen is the revenue share comes in, it just goes right back to the participants' accounts that it was taken from. So whether they're using a share class or an investment with revenue share or not, it all goes back to them. And then Prudential would just simply say, here's a fee that everybody pays regardless of their account size. Let's say it's $100 a year. Everybody would pay that fee, whether they have $10 in the account or whether they have $100,000.
Would that be prorated for the number of quarters they've been in the plan, though, or is that just if you started in December, you pay the whole year?
I believe it's a per capita fee that you pull each quarter, Kelly.
So it's quartered.
Yep. So those that come in the plan. Yep.
And I would just have some concern, I guess, about both the fee policy and the investment policy, in that, again, the HR director is supposed to be the one administering and designing benefits plans, and I would think it would be a good idea to hold off until he has a chance to understand these proposals and weigh in on them at least, because I think there are definitely arguments to be made on per capita versus asset-based and that kind of thing. And so I haven't been very involved in this in the time I've been back, and I just think it would be a good idea for him to be have the opportunity, I guess, to be a part of that decision making. Also, just looking at the investment policy, it enumerates the duties of the advisor consultant, the record keeper, the plan sponsor. I don't see duties of the committee listed. Are they in there, or is that? Okay.
So under section 7, investment committee, well, it will.
I know that we had changed some of the language,
Yeah.
and it's the very last section, I believe.
And partly I bring that up because to me, I mean, this is different than we used to operate, obviously. Oh, okay, there it is. And so I'm still not really clear and trying to, transition this to Ralph, exactly how these are supposed to work together, the Board of Commissioners versus the investment committee. And I did come across the resolution, I think, that set up the committee, just as I was clearing things out of my office. I probably brought it down, but anyway, it talks about a 403B plan. It doesn't even name the right plans that we
Yeah.
have, and so I just think there might need to be some cleanup work done on that as well, but, you know, maybe to just readdress the
Yeah.
whole issue of how this committee makes recommendations and, anyway.
Well, and with this, so I think you bring up a good point, Lena, with the investment policy statement that's here. We spell that out, and typically that board is referred to, the plan sponsor, and the board is referred to as the committee, so that's how that language is spelled out. I'll emphasize, these are your policy statements, and they're not contractual. We want to make sure we state that as well. I mean, these are not a contract of, hey, this is how it
Right.
has to happen, but this is the policy that we're trying to follow and do that. And so, yes, your input is more than welcome. I probably should have done a better job on the fee policy statement. That was certainly meant to be a draft. I know Dave has kind of weighed in on some of those things and looking at
Right.
it, but for the committee.
And I'm not saying I didn't have the
yeah.
opportunity, but
Yeah.
I didn't focus on that
Yeah,
on the
yep.
time I was here, and I
Yep.
know.
No, understood. So
How important is it gonna be in order to evaluate whether we want pro rata or per capita? Won't that decision have to be made before the RFPs can really be decided upon? Not necessarily.
But
A lot of
not
them
necessarily,
have
I think,
that
because
proposed
they all have
ways,
options, so
but-
Have
either
both,
way.
at least both options then.
Some of them have, but we can.
yeah,
talk more
and
about
I would
that.
say most providers are now, have the ability. I can't say with certainty that every provider that
Yeah,
that did that, the way that we had them provide their fee was basically just say, give us your fee schedule, what you would need in fee in order to service these plans. How we structure that fee is usually, we can do either one.
But it's a straight fee, whether they get it pro rata or per capita.
We
Or,
actually
yeah.
have plans that do both,
Do both.
where if you have a lot of small account balances, it's an X amount of accounting days, and then the asset base is above and beyond, or vice versa. It's really very flexible, so whatever you deem you would be.
and that's what I worry about, that we have, you know, especially new employees or employees with small balances that then get charged, you know, some amount almost equal to their balance, and is that fair? And, because again, we have to think of, you know, all kinds of participants that we're making this decision for, that will, you know, be affected by it, so
Well,
you can make arguments both ways, I know.
I would move that we continue the investment policy statement and the fee statement for our next meeting so that Ralph has a chance to review those.
I agree with that, and I'll second
And we
that.
have
Not this Ralph, but that.
This Ralph too. And we have a motion and a second to continue these two policies for a decision at the next meeting in order for Ralph and others to review further. All in favor, say aye.
Aye.
Any opposed? Okay, motion carries 5-0.
And I would just echo, we're available to take you through, and, I mean,
Okay,
it's us and our risk attorney that have drafted a lot of these documents, so we're happy to take the time we need to explain and make you answer questions. And again, they're your documents, so they really are, whatever changes we need to do to reflect the committee and the dynamics here, we can do.
great.
Can you comment real quick on the committee charter?
Yes. So the committee charter, which is one of the action items we talked about last time, and I would say is kind of the next phase of documentation. So you have your investment policy statement, you have your fee policy statement, and then the committee charter. And that document specifically details what Lena was alluding to, which is what power is this committee given in terms of decision-making for the plans. And so that committee charter, that would be kind of the next documentation we'd want to have in place, because it would very clearly say, this is what the committee has the ability to do, this is what the commissioners are responsible for, and would detail out those dynamics so that it's clear, so that each member of this committee understands what their role and responsibility and liability is, and
Right.
vice versa.
And I think that's important too, to understand the fiduciary role and,
Yep.
and so forth, but just sort of as a historical perspective, originally this committee was set up by the HR director to sort of advise the HR director on making these kind of decisions, and then, I mean, it did become more formalized, but it was still used in that way as far as final decisions on investment lineups and plan provisions and features and so on. And so the way it's structured now is different, and I'm just not sure if it works as well, and if it's, you know, are we then insulated from liability if they don't take action? I don't think so. And so, you know, and are they making decisions based on whether they have access to the same information? And, you know, so I think there are some things to talk about there and continue to look at.
Yeah, that's the very purpose of the committee charter, so that I think it's a protectionary measure for the organization. Say, hey, look, these are responsibilities have been delegated, and it's a protectionary measure for those on the committee to say, this is what I'm allowed to do and what I'm not.
Right.
So,
And this resolution needs to be fixed to name the right plans. But, can maybe happen in conjunction with some of this other stuff. Okay, should we move on to fiduciary training and updates for the fourth quarter?
yes, so I think we can move through this pretty quickly. One is in October. We're working on the date. We kind of had it set, but we're moving it around a little bit. We'll have our third fiduciary training that we'll hold. It'll actually be here in it'll be in Salt Lake City. We typically do it right downtown. It'll be from about 10 in the morning till about 1 o'clock, 2 o'clock with a working lunch. But we want to encourage you. We'll get the dates to you as soon as we can in terms of your calendar. It'll be an important training. The next item on the agenda there is called the SIF Fund Initiative. And again, I don't want to spend too much time, but a lot of this training will focus around this. And what the SIF Fund Initiative is within the last couple of years, collective investment trusts have become more common in usage of plans, and our ability to be able to put those in place with managers has become much better. And so essentially what Soltis is doing, I think for this committee, is we have about a little over $4 billion of assets that we advise and manage. And what we're effectively trying to do is go to a number of these investment managers that we have pretty sizable positions, and we negotiate a specific share class just for Soltis. We can go and say, hey, we hold, you know, $800 million in this fund. We don't want to pay a retail share class. We want to pay an institutional type of, that's even better than institutional. And so we've gotten to the size and scale where we're able to do that, not across every position, but across quite a few that are actually currently in your lineup. And so we're right in the middle of those negotiations, and come October, we're hoping to roll these out to where there will be pretty significant fee reduction. Our initial negotiations have been very compelling to where we're pretty excited. And essentially that is again, it would be a specific share class that Soltis is able to use, that only we have access to because of our size, that would basically help you get pricing, say at $160 million across your plans. We'll have pricing that would be more reflective of a $2 or $3 billion plan.
So this is pricing on existing mutual funds that you just get your own share class.
Yep. So for example, like T. Rowe Price, we have a pretty sizable holding in that. You guys use it. We use those as the target dates in your current lineup, and we can go and negotiate the exact same fund with a lower share class, and then use them in the plan for just the specific Soltis share class for pricing that would be across our entire book of clients. So it's a little bit of like a cooperative, but it's Soltis that comes together and says, look, we're directing these assets, so we have the negotiating power. And we've been on calls the last 2 months with different investment managers having this discussion about offering a collective share just for us. And we haven't had a manager say no yet.
So is there any difference between that and a collective investment trust, or is that what it is?
It's the same thing. It's just a collective investment trust set up for us. So most of the time they get set up specifically for large plans where you see CITs.
Right.
Or SIFs is in like $1 billion plus plans, because they'll go and say, hey, we have 500 million in that one. We want a better share class, and they set them up just for that plan. What we'll have is actually a collective investment trust that we can not only use with you, but with other clients as well. You get the benefit of our other clients, and our other clients get the benefit of Utah County.
So how does that benefit an individual employee?
So instead of paying, let's say they're paying 75 basis points for an expense ratio, that expense ratio goes down to say 50. And initially, as we've run kind of the numbers, it's coming close to almost $3 million a year of investment expenses we think we're going to save on an annual basis for our
But
clients.
you'd have to spread that out between all.
That's
your
across
clients, right?
that's across our, yeah. But it's pretty compelling, and of course, you know, we don't get paid anything or any additional. We're just simply going and trying to negotiate, the very best expense ratio we can for our participants.
And so you can get better deals than like what we get through Prudential on certain funds, I guess, are you saying? And
Well, let's
Yeah.
say, like in your plan with 150 million of assets, let's say you've got a position of 20 million that we have in your plan, but we can go, like, let's just use T. Rowe Price, for example. In your plan, I'm trying to think of I've got it in here, but let's put it at, $50 million that you've got in the T. Rowe Price target dates. We have 500 million in them across our clients. So rather than go and say, hey, T. Rowe, we want a price for 50 million, we can go to them and say, we want pricing for 500 million or 800 million. And then we can take that share class and we can put it in your plan. You have the exact same fund, the exact same management team, just a lower expense ratio. And we work with Prudential. Once that share class is created, we work with Prudential to get that on the platform.
Is that something we have to adopt, or is that something you're just planning on doing?
It's something like a fund change. It'll have to be adopted and replaced. For example, if we were to move to that, we'd say, hey, we want to replace your T. Rowe Price 2020 fund with the
Oh, okay. So it'd
with
be
the
a fund
CIT
change.
T. Rowe Price 2020 fund.
Is
So,
that- Go ahead.
so there's still some moving parts there. Like I said, we're right in the middle of negotiations, but we're to the final stages where we're confident and there's going to be pretty significant savings. And we've gone through your plan, and there's quite a few positions in your plan that would apply to. Not all of them. We won't have a CIT for every fund in every plan. It's got to be those positions. It's usually when you're reaching $100 million plus in those type of positions.
So would that have any impact on like your ability to impartially recommend funds and so on if you have, those types of
No, it's a-
relationships with certain?
It's a really good question. So we just negotiate the share price, but they have to continue to perform. And if they don't, we simply will go, just like replacing a fund, we just replace the manager inside of the CIT. So, and it actually is a little bit cleaner because you're not changing a fund, you're just changing the manager. You don't actually have to go through the hoops of doing a notice and all those type of things. So for example, if T. Rowe Price began to underperform, we could go to Putnam, we can go to anybody else just like we would in any other fund and say, hey, and by the way, let's say we have an $800 million position. We have $800 million position in this. We'd like to talk to the manager. We'd like to talk to your team and make a decision. So we'll be able to monitor and replace managers just as we always have, but in a cleaner and less expensive way for participants. So in October, a lot of the fiduciary training will be around that. One of the big reasons that we push for this is if you look at, one is it just simply puts more money in participants' pockets. If we can get them a lower share class, we want to do it. And two is if you look at litigation, the large percentage of it is around share classes that plans were eligible for a lower expense and they just didn't use them. And so,
So is that the semi-annual training? Is that what that is?
yeah. Well, there's actually 3. We hold 3.
What was that? What's the
Yes.
Fall High Network? Net worth?
So the Fall High Net Worth Symposium is we have an annual conference for individual clients.
Oh, okay.
And as a courtesy, we extend that invitation to any of you. It's not around plan sponsors or retirement plans per se. It's more around individual, but we extend the courtesy invitation of any of you that wanted to attend. You're more than welcome to come and be part of that conference. It's really more around financial planning and estate taxation, those type of things. Any additional questions there?
One other note on the business calendar, we are still scheduled for our next meeting November 5th. I just want to confirm that that's good with you guys.
November 5th, so that's the first Monday after the end of the quarter. Are we doing first Mondays or second Mondays? I think
We
we've
just
had
got,
some of both
originally we got a calendar from Cami that just stated
that
the
had that
dates.
date on it.
Mhm.
I think the 5th for sure was because the 12th would be
Oh,
There's a holiday.
Veterans Day.
observed.
okay. So will we have information by then for the end of the third quarter?
Yes, we'll have, yeah, for September. And if that date's flexible, I actually have a conflict where I won't be here, our team would be, but if there was flexibility to move that, I'd be happy to do that. If not, Brent and Bill and our team and Lindsay can certainly
I know, Elena, the reason we had shifted it prior is because sometimes Prudential, it was hard to get everything ready and out the door by
Right.
the first week of the season.
Yeah.
It's also better for me to be the second week rather than the first week because of distribution.
So our standard week is the second week, but in November,
We moved it up for
it's
just,
Monday, so the
We moved it because the 12th was
12th would
Veterans
be a
Day.
Monday.
Yeah.
Oh,
This is a holiday.
oh, I got it, so I was thinking it would be falling on
It's
Tuesday.
Veterans Day.
So if we need to, we can,
what about Tuesday, following day or
You
something?
do the
Yeah.
12th or the 19th?
we could do
Or-
the 13th.
I don't care what you do.
The 13th works for me.
Are you available then, Lynn?
No, I don't think so.
Lena, are you gonna be attending?
The 13th, are you?
If it's in the afternoon, we're okay because commission meeting is in the morning. but-
Right, so Tuesday afternoon, November 13th. Ralph, you good with that? I'm talking to the other Ralph, but what do you say?
I know, I think I'll be out of town that week, so,
Really?
but that's okay. We can hold the meeting.
Okay, as long as we still have a quorum, and I think we probably will, so, it sounds like, at least for now, plan on November 13th,
3 p.m.
Tuesday, 3 o'clock.
Okay. Okay. I think the last thing, just on regulatory update, I was mentioning to Kim earlier, Kim Anderson, our president and CEO, and myself, we sit on the, Kim sits on the Government Affairs Committee for what, an association called NAPA, National Association of Plan Advisors, and we once a year go out and actually spend 2 days meeting with lawmakers on kind of current legislation they're considering and doing, and there's some neat things that have passed the House that are moving before the Senate, and one of those, I don't know if Utah County, do you guys have it as part of your health care, an HSA type of option?
Yep.
So right now, there's a bill in front of the House, just a quick update, I think here. There's a bill in front of the House that would integrate HSAs into 401K plans. So you wouldn't have to run them separately. I don't know if you use Health Equity, they're a big player in that space. But you would essentially be able to say, look, I can just integrate them into one. And your investment menu and the plans will look identical, almost mirror each other, but your participants would have an HSA account. They'd log into like their 401K and they'd just be able to see my HSA account and my 401K account. And then the investments would be the same so that the participants have the ability to invest and do that. And so that would be a big change. We've seen this big push towards kind of convergence of, you hear the convergence of health and wellness. And so that bill's in front of Congress right now, and we're hopeful that it will pass. I think it would be, we get a lot of requests right now from clients that say, hey, my HSA, it's growing and it's turning into $5-10 million that's sitting out there, and what do we do with it? And so this bill's obviously to say, look, we can help and make it efficient to where it just integrates right in with the 401K. The participants could have a single advisor to say, hey, help me with my 401K. Now let's talk about my HSA account. What investments would be appropriate? And we can structure them accordingly. So I think kind of stay tuned, but that's one of the big changes that's sitting on Congress's desk right now, waiting to.
Are the companies really set up to do that? Somebody like Prudential to administer both ends?
I'll-
If it ends up being federal law,
They'll get that.
Not
We
much
actually,
You're seeing
What does that do though to all the HSA companies that are out there?
they'll have to compete.
or merge or something, maybe.
They'll have to
but
compete.
We actually had, I think, 1 or 2 of the RFP responses talk about that.
Some are already there. Some.
Yeah.
Does Prudential? Does Prudential have currently an HSA option? They don't yet, right? Yeah. There's a couple of providers that have that already, but you can't integrate it into the
we just
plan.
haven't launched it
Yeah.
fully.
But I mean,
Probably buy out a company that did it, I'm guessing.
That's not gonna
Rather
open the
than try to
door
start
for
it
them
from
to try and tax it out the door, are they? Because that's the nice thing about HSAs is there's no tax if it's just
The
a
bill
program.
doesn't consider any change to the taxation provisions that are currently in place for
Yeah,
HSAs.
but anytime you have a new bill, you run the risk of them slipping something in there, but.
You do. This one's kind of getting slipped in around on the budget bill potentially.
Okay,
and I think we probably have very few employees that think of their HSA as an investment vehicle. It's more a savings account for, spending, and so I'm not sure that, that's something we need immediately, but maybe eventually.
It's being
as
talked
people-
about more and more though, since they've been around now for a
Yeah,
while.
yeah.
People have larger balances and they wanna earn something on them.
Well, there's some real benefit to participants to say, look, if you can build this thing up over a few years,
Yeah,
and then, you can not only have contribution growth, but you can have investment growth, and then you can still use it. And there's some real benefit, once you're 59 and a half and after that, you can pull that money out and use it. You can use it, and it qualifies for expenses you may have paid for 5, 10 years ago. You just have to say, yeah, I'm gonna take this money out, I'm claiming that it was gonna be used for surgery I had 4 years ago. So there's triple taxation or triple free tax benefit to 59 and a half and older, or 65, excuse me, yeah.
so
So
you're
there's
saying the taxation isn't changing under these.
the
proposed
current
bills?
legislation that's in front of the
Yeah.
House
I mean,
and,
because you can do that now.
and the Senate. Yep, it doesn't change the taxation provisions at all on HSAs. It simply says, look, rather than have them be somewhere else, you
Mm-hmm.
can just integrate them right in with your 401k. Today, you can't do that. They're two separate
Yeah.
benefits, and ERISA says you can't commingle them.
Right,
But that law would change that to say, yeah, you can integrate them right together. And then, for example, when we sit with a participant, you could say, hey, let's talk about your 401k, have that conversation. Okay, let's turn to your HSA now and let's see what you're doing there. Let's see if we can help you there. And help them understand, educate them on those accounts, what they can do. Most people don't know the 65 triple free taxation or triple free tax benefit that comes there. It's no taxes that go in, say triple free, but it's triple free, but it's no taxes when you go put it in, no taxes on the growth, and if you take it out for medical expenses, you don't get taxed on it either.
right. Well, I think we've tried hard to educate on
Yeah.
that part of it, and our current HSA, they can invest once their balance is $2,000 or more, but I don't, like I say, I have a hard time building it up to the point that I can care very much, but.
And the investment part is not stressed a lot, I don't
No, it isn't,
Yeah.
but it is available, but, yeah. this is
Well, and right
something
now,
that
I
we
would say that's not a strength of most providers. Most, when you look at what investment options are
Yeah.
available, they're pretty limited.
Yeah,
Oh, they
So
are
this would
limited.
also give participants a lot better access to better investment vehicles.
okay.
It's also kind of an indirect incentive to stay healthy too.
Yeah, well, we got that now, and I,
If you
So-
can.
yeah. So that's what the RESA, what does that stand for?
Yeah, RESA is the bill that, there's a number of provisions in there, but that's probably the most prominent one. That's the bill that NAPA's actually helped kind of draft and lobby to go before Congress to try and extend and make these benefits more accessible and better to current participants.
Well, even if you could get a guaranteed rate on, if you just have a little in there, that'd be better than what they're paying now.
Yep.
Which is zero,
Yep.
not quite zero, but pretty darn close.
Well, and it'll be interesting. I mean, there's lots of good data that shows under HSAs, people are more mindful of their healthcare expenses. They do a better job of shopping and controlling them. And so I think we don't see HSA really going away. We see it continuing to grow, and as it does, we continue to have more and more clients that say, hey, we rolled an HSA about 5 years ago, and now we have $10 million that's sitting in there, and it's an ERISA governed plan, not for you guys, but for most. So they're kind of going, well, we're worried about it, what do? We want to make sure that, just like a 401k plan, that participants are using it wisely and they know what they're doing with it.
Well, certainly something we want to watch and get more information about.
So we'll keep you apprised as kind of the developments that happen there.
Okay, shall we move into the investment review?
Yes. So if we jump into, there's the investment, plan investment review tab, if you go to that section. And you'll see a report on each of the plans and the underlying investments in each of the plans. You can, and we track those, we track them year by year. So you'll see on there, the left-hand side on page 24, 25, and 26, we're taking a snapshot of the asset allocation across your plans from 6 months ago, and then we watch it. The reason we do this is we kind of want to track and just make sure that you don't have, participants that are chasing markets or chasing returns, or it helps us gauge kind of, some of the things around your plan that we can maybe help educate and help your employees on. And So you can go through and you can see that. In terms of breakdown, it gives you a weighted expense ratio for you to look at. That tells you basically across the different investments and the expenses. That gives you an idea of what the investment expenses are.
How come our balances are lower? Is that withdrawals?
You've had a little bit of a choppy market. A little bit of a similar story. You've had the S&P 500, which has come positive year to date, but bond market's negative, international market's negative, emerging markets have been negative. So it's been a little bit of a unique year that basically anything that's not S&P 500 has been a little bit underwater. If you look at page 27, this is just a quick summary of the qualitative and the quantitative criteria that is spelled out in your investment policy statement. So as again, just as a quick refresher, we prefer to set a pretty high bar for the investments in your plan. On a quantitative basis, essentially what we're looking for is we want them to be in the top third of their peer group and or beating their passive index. And so for those investments in your plan, they need to be meeting that criteria to be in the plan, to qualify for the plan and go through it. And then of course we've got a couple to report on with their if they don't meet that. And then underneath that is a qualitative scorecard, which means these are a number of the qualitative elements that we're looking at with each of these managers. Their tenure, their style, their risk-adjusted performance. Not only do we want to see good performance, but we want to understand how much risk that manager is taking. Of course, their expense. You can see there as a qualitative measure, one of our criteria is that they have to have an expense ratio that's below, at or below the category average. So we want to use investments that are typically, less than the average manager is charging in that space. And then, of course, size, how many assets they manage, et cetera. On the very next page, 28, is a quick summary of the funds in the plan, in the plans. And you can see there's 3 that technically hit watch status, and we'll report on those. And then you'll see in the column right next to that, recommendation. Again, as part of the follow-up from last meeting was to look at your menu, not only evaluate your current share classes, but look at your current funds. And we did come back today with some recommendations around some things that we think would help enhance your current investment lineup. Some of that is you've got some duplication. In other words, some of that is you've got good managers. You'll see some of these replacements are for managers that aren't on watch. But we feel like that there's managers that we have a higher level of conviction in that historically have performed quite a bit better that we're looking at. So let me just go through each one of these. So you'll see the Janus Henderson Flexible Bond. That is your main kind of core bond exposure in your plans. This has been a pretty good manager. However, they have, when you look at their returns, they've done a pretty good job in terms of they've outperformed the benchmark on a rolling 5-year. They've been pretty consistent. They have had a little bit of turnover in that fund, and I'll take you to page 35. And our recommendation is to replace this manager with Metropolitan West. This is a team that Metropolitan West has been around for 2+ decades, but it's essentially some of the key management people. If you guys are familiar with PIMCO Total Return, ran by Bill Gross and a number of his tenured analysts, a number of that team left and started Metropolitan West. So this is a good experienced team. They've been at Metropolitan West for 2 decades, and they've done a very, very good job. If you look at page 35, it just kind of shows you stacking up Janus Henderson Flexible Bond with Metropolitan West. I think there's a couple of things. One is I'll emphasize Janus and Henderson has done a pretty good job. They've had pretty good returns. More recently, their 3-year number and their 1-year number hasn't been quite as good, but longer term 5 and 10 year they've been very good. If you look down in the middle of that page, you'll see the expense ratio. You'll see that both of these managers are under the category average of 0.77. But Metropolitan West is even a little bit more inexpensive at 0.67 versus 0.70. If you look at over on the far right, where you've got first quartile, second quartile, and percent beating the benchmark, you'll see that Metropolitan West has very consistently been in that first quartile, whereas Janus Henderson's only been there a little over 11% of the time. Now, Janus Henderson has been they've been in the second quartile, which means that a very high percentage of the time they've outpaced their category average. So again, it has been a good manager. But then if you look over to the right where it says average excess return, you'll see that Metropolitan West historically has provided an additional percent of excess return above and beyond what Janus Henderson has provided. And so those kind of elements, as I mentioned, there's been a little bit of turnover on the Janus Henderson manager. The Metropolitan West team we like, and we just have a higher level of conviction in that manager. So our recommendation there is to replace the Janus Henderson bond manager with the Metropolitan West.
Is this the first quarter they've been on watch?
It is.
And what does the investment policy draft say about that?
So we don't set a specific time limit on how long a manager can be on watch. There's a little bit of art and science to that research. Sometimes it's managers out of favor, some of those type of things. So we don't specifically stay in an investment policy statement. If they've been on watch for more than 1 or 2 quarters, they have to be removed. We leave that open-ended intentionally. Is there any other questions around there? The last thing I'd probably just say there is Metropolitan West is one of the managers that we are negotiating for a SIF alternative, so that 0.67 will very likely even go down pretty dramatically. Questions there? There's on page 36, there's kind of a write-up that gives you even more of the details around the management team, some of the departures that they've had, et cetera. Okay. The next one, I'll hit these two together, is you have 2 funds in here, Invesco Growth and Income and JP Morgan US Equity. Both of these are large cap value managers in your plan. And if you look at both those managers, I think I'll tackle them one at a time, but Invesco Growth and Income, they've been a deep value manager. You'll notice that neither one of these managers is on watch. In other words, they've met your criteria. However, their performance here more recently has been a little bit more difficult. Again, these are 2 good teams, 2 good managers. So it's not a matter of, hey, let's replace them because they haven't done so well. But the manager that we like a lot more in this space is a manager by the name of Bill Nygren at Oakmark. It's probably one of the longest holdings at our firm. He's done a very exceptional job of being very consistent. You have 2 funds that are in the same space, essentially. You got 2 large cap value funds, so this is also kind of an opportunity to consolidate a little bit as they're managers that cover the similar space.
You're talking Invesco and JP Morgan?
Yes.
Are in the same.
Yep, and if you look at page 31 and 33, you have the comparison that we have drawn for each one. So on the Invesco Growth and Income, you'll see from a performance standpoint, they have struggled. They haven't been as strong. You'll see that for the last 3 and 5 year period, they're actually close to that bottom quartile, and on the 1 year, they're actually in that bottom quartile. Whereas Bill Nygren, Oakmark, you can see that he's been very consistent in that upper two quartiles, and on the 3, 5, and 10, he's been in the upper quartile and done a very good job. Now, Bill does have a little bit higher expense ratio than both
Bill
of
is
these funds.
Oakmark?
Yep. This is Oakmark, yep. So he's at 0.86 versus 0.49 for Invesco, and then versus 0.69 for the JP Morgan. Now, I'll mention there, this is one of the funds that we are currently negotiating with. So that expense ratio that we're currently using, we expect that to, we're confident that that's going to be one that we'll have a lower option for as well in the coming months. If you look at excess return on the far right for both of these, you'll see that both, Invesco's actually been, on the last 5 years, they've actually been under the benchmark. They've performed less than the index. JP Morgan has outperformed just by a little bit at 0.12, whereas Oakmark's been more than a percentage point better than the S&P 500 over that same time period. So that's a recommendation we have for those two managers in that space.
So why isn't Invesco on a watch list if you're saying they're underperforming, but not according to investment
So they have,
policy?
so their peer group ranking is where they're there, but if you look at them versus the Russell 1000 value, they've actually, that's where they've held up okay. So that's a part of the market that's been more recently a little more difficult, but their longer term numbers against the Russell 1000 value index, which is their benchmark, they've provided performance there. So that's what qualifies them to not be on watch. Any questions there? Okay, the next one is similar, the ClearBridge Large Cap Growth. We use the T. Rowe Price Blue Chip Growth. Let me go to page 37. And this one, I would even say more so ClearBridge has been good. They've done a good job. It's a good manager. If you look at their performance again in the middle of that chart, you'll see that with the exception of the 1 year, they've been in that upper quartile for most of their tenure. So good manager, has done a good job. What I would say about T. Rowe Blue Chip is they've been a little bit better, including on the 1 year. They've been pretty much in the top quartile since the tenure of their fund. You'll also see the expenses a little bit better for the T. Rowe Blue Chip. And then you can see from a consistency standpoint where ClearBridge has provided almost a 1% advantage over the benchmark. T. Rowe Blue Chip's been closer to 1.5% better in that space. And then again, the last thing I'd mention there is this Blue Chip is also one of the funds that we're in negotiations with for a lower share class. So the expense advantage that currently exists will only likely get bigger for T. Rowe.
How soon will you know if your negotiations work out?
We're hopeful to have them in place by November 1st. That's kind of our soft target in terms of being able to have them, the share classes in place and fund them. So
would your recommendations be the same even if that didn't happen? If you don't
yes.
Would doing it help your negotiations? I mean, is that part of the reason you're recommending this?
No, because right now you guys don't hold these funds already. Well, it helps a little bit in that we have gone to them and said, hey, there's additional flow. If you're willing to do this, we do have other plans where we may have a more compelling reason to bring a better manager in. But we've essentially, the negotiation, the pricing, the way it's done is we go through with what our current holdings are. But as these grow, most of them have price points. So let's say there's a price point for us at 100 million. They have another price point at 200 million. So as our business continues to grow and we continue to have more price points, we'll be able to further negotiate those down.
So you're saying then that we have a better chance of us benefiting from what you're doing than
Yes.
us benefiting you in your negotiations?
Yes.
right?
Yeah,
What
I mean,
about- what about the
for-
effect, sorry,
go ahead.
what about the effect on the employee? We seem to be changing a lot of funds at the same time.
So I think when, what we would typically want to do or advocate is that we would be able to come on site and help educate your employees on why some of these changes are being made, and make sure we can communicate to them. In addition to just the fund change notice that typically goes out, we would want to provide you with a supplemental communication that kind of explains why and the benefits and, why we think these changes will only help the participants. But in large part, we want to try and help communicate to them why the changes are being
You
made.
had any feedback?
Well, I was gonna actually bring that up before you did, but yeah, just looking at it as an HR director, that's what, 6 fund recommended changes at once. We just did 3, 4.
Yeah,
So
Yep.
I worry about the perception, like, because it sort of makes it look like, oh, they just chasing returns, or they don't know what they're doing because they keep changing things, and besides the confusion aspect of it,
Or what have we been in the past if we're supposed to be?
exactly, yeah, if things must have
Did we
really
mess
been
up?
bad if we have to change everything at once, and so, I mean, and especially changing things that aren't even on a watch list according to our policy. I just wonder about sort of the psychological fallout in terms of employee perception, as well as just the mechanics of, doing a lot of them, but that part of it is,
so I think we'd say we'll take direction from the committee. Initially, that was kind of what we had done. And then in our last meeting, I think we had been given the assignment of, hey, not only look at the share classes we're using and what's not on watch, but look across your entire menu. And so we just came to you today saying, if you were to say to us, hey, if you want to put the very best managers that you think you can find in the plan, this is kind of along the lines of our research and our recommendation of where we would go.
And my view there is if there's a better fund, that's the fund we need to be in. And if we have to change often to be in the best funds, I don't think we've done a lot of changing, but we do have a new investment advisor through Soltis. And at the last meeting, we asked them to give us their very best recommendations of what funds the Utah County employees should be in. So I would rather be in the best funds and deal with any employees that have questions. That's easier to answer than an answer to an employee who says, why weren't you in the best fund,
right.
in my view.
I mean, if it were completely obvious that these are the best funds, and that's, goes
Well,
back to
Yeah.
how do we arrive at this decision that these are the best funds, and is it following a course of action that we've sort of outlined we're gonna follow and all that kind of thing, because it's, it's process as much as the result in some ways. And I'm not disagreeing, and I'm not saying we shouldn't do it, but we just have a lot of sort of upheaval right now in the committee, and then the RFP being out. I don't know if that might make any difference on, where we would end up fund-wise and so on. But,
So it is a little unique in that there are, I would say a lot of times when we revamp a lineup to this extent, it's because there's more on watch. And you have some good managers. Like I said, they like that Clearbridge large growth. They've done a good job. That's a good manager.
right, and historically, in investment policy statements, it's typical to say we're gonna watch
Yeah.
them for
Yep.
2, 3, 4 quarters before we make a change for this very reason, because you don't wanna say, well, they did great here, so let's switch. Oh, now somebody else is doing better, so you just keep
Yep.
switching. And so, there's some value to the stability of the plans too, so,
So
I
we
don't
want to be
know.
sensitive to your employees and how you do.
Yeah.
We'll be as accessible as we can, and you need us to be in terms of trying to help communicate that to your employees. I think normally when we do this, if there's going to be those type of changes, it will be, hey, we'll come on site and do our very best to explain to your employees, hey, you're going to see a few changes that happen in the plan. You've got a great benefit. You've had good investments. We're trying to make them a little bit better. In that, we haven't gotten there yet, but there's also a few spots in your investment menu where we feel like having some exposure would be beneficial. So we also have a few recommendations around adding a manager to give you a little bit more exposure for parts of the market that we think would be beneficial to your participants. So there's a, not to overwhelm, but there's those changes, and
Yeah.
then we have a few additions as well. And they can be done in steps, they can be done all at once, or we can, again, we'll kind of take direction from the committee. The last one I'll just touch on there. We've already talked about the Dreyfus mid-cap and moving to the Fidelity mid-cap with the expense ratio just dropping significantly. You go from 50 basis points down to 7, right? 6.5 or 7. Fidelity keeps changing about every, about every other week we get an email that says, hey, we just dropped our index expenses a little bit.
Where are you now, sorry?
On the middle of the page, on page 28, excuse me, the Dreyfus Mid-Cap Index.
Oh, okay.
It's 5 bips.
Okay, so you go from 50 basis points, or 0.5% down to 0.05 for the exact same index.
And that's on page
And that-
46.
Yep. And then the last one in there is the ClearBridge Small Cap Growth, which when we came on the plan, the decision had been made to change from that one to the Fidelity Small Cap Growth. And Fidelity runs they've got a good team and a good management team as well, but kind of to the assignment last time and looking at that. So we initially looked at that, and that change was already approved, or was already going through. And I know it kind of got held off, but we looked at that manager and said, hey, this is a pretty good team, and they've done a pretty good job. But again, if you were to come, we took the assignment of, hey, if we were to put who we think is the strongest manager in that position, there's a Janice Henderson, Triton Small Growth manager that we like and use, and they've done a very good job. And it's a pretty similar story as the ones we just went through. That one's on page 39. You've got an expense ratio that's quite a bit more advantageous for Janice Henderson at 0.67 versus the 0.91 that's currently in the ClearBridge Small Cap, and actually the Fidelity Advisor Small Cap Growth is 1.07. So that was actually an increase in expense. So the Fidelity one is what's going in, and that would be 30 plus basis point change in expense ratio for those. But again, if you look at the ClearBridge and you look at the Fidelity, those have been good managers.
We just recently changed to ClearBridge, is that right? Or-
Well, that one was in process, and then we kind of held on it.
It was supposed to change to the Fidelity small cap fund, but it didn't. From here, it didn't get approved by the commissioners, from my understanding. So
that one's
change
been-
never went through.
Yeah.
So that replacement, we've just been waiting.
Is that
ClearBridge-
right, Kelly? 'Cause
ClearBridge
I
Small
thought we
Cap
did
Growth.
everything,
It's changed.
It is changed.
Yep,
Okay.
Fidelity Advisor Small.
Did it go in July?
Institutional fund.
Okay.
It went, August 9th, when all these.
All
Yeah,
those
we just
changes,
did.
okay.
Oh, okay.
for
so-
fund
Okay.
changes.
Which we wouldn't have that.
Are they
So what, we
reflected
added
here?
We added 2 index.
Yep.
funds, and then we changed.
Okay,
And that just happened in the overnight cycle on the night.
okay.
So
Okay, so,
ClearBridge is now Fidelity.
yep,
So we're, yes. Fidelity 500 index premium.
Yep.
Fidelity mid-cap index.
So that
Fidelity
mid-cap's
small
already in there,
cap,
yep.
And then Fidelity Advisor Small Cap.
okay. Thank you, Kelly, for helping me clarify.
Which this factor wouldn't have it updated because it's out of the.
6:30.
So 6:30.
Right, but so we've already changed that one, but not to the one you're saying now is the best.
Janice Henderson, Triton is the manager. And again, we looked at, the Fidelity team's a good team. They've done a good job. They have really good numbers. So again, we just came with the assignment of if you were to ask us what our best manager in each of these spaces are.
Because that transition to Fidelity was in progress before you came on board, is
Yeah.
that right?
It was, and then it got held up.
Yeah.
So it was initially supposed to go through, I think, towards the end of the year. And then, yeah,
We put it on October or the November meeting.
forgive me. I do my best to try and make sure I know when all the plan changes happen, but we have a
Well,
few,
I'm trying
we
to
have a
figure it
few
out
plans, so.
myself.
But yeah, it was in progress, and then it got held. And then, as Kelly mentioned, I think in our last meeting, the index in that one was one that we'd come and forgive us there. I know Lindsay was out as well, for a little bit on maternity leave, so.
Okay,
We giving you enough yet?
I think a little overload.
Ralph, how you feeling over there?
Great, yeah. He's okay today.
He's
It's
rethinking,
tomorrow
he's
that's, the issue.
So, so those are the recommendations in terms of the investment menu. Again, we'll kind of follow direction from the committee. on the bottom of page 29, and I want to make sure we give Kelly some time, because we've taken our fair share. On the bottom of page 29, you'll see that there's a few additions that we would recommend that you add to the plan. One is a global manager. Currently in your menu, you don't have an option for this. A global manager is a equity manager that can go out and invest in companies both in the U.S. and international markets. We think there's some really good talent in that space, and there's some inefficiency where a good active manager can do a nice job. We like a firm by the name of Grandeur Peak. It's actually a firm here in Salt Lake. I don't know if any of you heard the name Robert Gardner. But Robert is for us nerds in the investment world, he's a bit of a superstar. He was at Wasatch, which is also a local firm. He's been on Barron's, I think, 3 times as the top manager of the year. He left very amicably with Wasatch about 5 years ago. He's always wanted to have his own shop, and he's always wanted to be a global manager. So he does a very good job. That's a great option for a part of a portfolio to say, hey, I like a manager that isn't constrained by a country on where they want to invest. If they can invest in good companies, they can go wherever, and Robert's had very good numbers. Currently, you don't really have you don't have a specific emerging market exposure. You have Euro-Pacific Growth, and that's a large cap fund that mostly invests in growth companies in developed international markets. Whereas we feel that it definitely helps a participant to be able to have some pure emerging market exposure in your plan. And so our recommendation there is T. Rowe Price runs an emerging market portfolio. David Pagliaro is his name. He's run the portfolio since 2000 and has been very, very good.
Is that, Tyler, is that emerging markets just in the U.S. or is that
That's
globally as
international.
well?
So that's all international, nothing in the U.S.
So those are only international
Yep.
stocks.
Yeah,
most
so
of
right now,
these
right now in your
have an
plan.
international flavor to them, right?
Yep. Right now in your plan, you only have, for people that want to have an international exposure, they only have the one option, which is the American Funds Euro-Pacific Growth, and that's been a good fund. They've done a good job, but it invests in growth companies that are mostly in developed markets, so it gets very little emerging market exposure. It will have some. It gets very little small cap exposure because Euro-Pacific is a big fund, so it doesn't really invest in smaller companies, whereas T. Rowe Price will do some of that as well as just be a pure emerging market. And that's one of the most, I think, for us, and when we look right now over the next 5 years, we feel like that's one of the most compelling parts of the market in terms of opportunity and valuation. It's also a closed fund, but we have access to it. So a little bit of benefit there to Utah County is we have a position already, and T. Rowe Price allows us to continue to use it, even though it's closed to new investors. And then there's also we've added in here a T. Rowe Price Retirement 2060. That is for employees that you're now hiring if they're 25 or under. That's the closest target date to them. Right now you have 2055, and we all get a little older and have to introduce a new vintage there. That 2060 fund would be the more appropriate fit for those employees that you're now hiring.
2055, I thought we just had
Or
the
2050, excuse me.
0 decades. 2050.
And then the last one on there,
Gotta be long gone.
the last one on there is an total international index premium. So for those participants that want to index in your plan, this would provide them with an index option. So they'd have an index option pretty much everywhere in the U.S., in the mid cap, small cap, if they want to index. So if you have participants that just say, look, I just want index funds, that gives them an option in the international space to use one.
Can you tell me if any of those new recommendations are currently used in Goalmaker?
So, and,
No,
They're
you
not,
can't
'cause they'd
tell
have to
me,
be in
or
your
no,
main.
you don't know.
well, if you choose to go
Yep.
with Grandeur, we have to negotiate timing, and we don't even have that on our platform right now. Nice to hear that you have
We have a really good relationship there.
with them. So, because we couldn't put it on,
Yep.
you could make the call, and we could make that
Yep.
happen. Generally speaking, and you know Goalmaker as well as I
Yep.
do, we can do a customized Goalmaker. If you'd like to have some of these exposures within the asset allocation of Goalmaker, I can work closely with Tyler and his team to make that happen.
Yep.
So you just have to decide if that's any exposure you would want in an asset allocation.
Yeah, because Goalmaker is just customized using funds that are in our
Yeah,
plan.
In your current
Right
menu.
now you have
So-
just the general normal goal maker,
Uh-huh.
so that's just, you know, what Morningstar has told us is the right asset allocation for each sleeve. We also have an advisor goal maker, where we work very closely, and that sounds like the direction that we would go if we would start adding any of these goal makers, we would probably wanna
Yep.
work on those as well.
So that's a conversation, or it's one of our initiatives is Prudential will run it, so you run their standard program through GoalMaker, or most of our clients will have us help in driving the asset allocation in GoalMaker, which allows us to go in your GoalMaker program and actually help with the allocation. And there's, we've been able to do that for quite a few clients through the GoalMaker platform and drive some nice return in that space. And that's one of the things on the list to get to.
So
Are they
you're
on
used
to?
to doing that then?
Oh, yeah.
But yeah, they've got to be to be in GoalMaker, they've got to be part of your menu.
Yeah, they have to be an underlying
A
plan
question
investment.
for you. Are you in negotiations for the collective investment trust on any of these four you're recommending?
T. Rowe Price, the 2060, yes. The emerging market is closed. So that's when they've kind of said, hey, we're
So
still.
the two on the front are the two highest, those would be the
Yeah.
one with most interest, but.
Grandeur Peak is Robert he's been so good throughout his career. It takes him about 2 months to close a fund. I mean, he'll open a new fund and it literally will fund and be closed. And his numbers he's been great. So, for him, he doesn't have to, because one, he's running smaller cap portfolios, which means he can't run, nor does he want to run $50 billion. So his portfolios they're a certain size. He keeps them and he closes them, which we like as a shareholder, because he's gonna, you can't reproduce returns if you get too big. So, and he's one of the largest shareholders in all of his portfolios. So he's interested in making sure his returns are good.
There is a write-up on page 42 for the Grandeur Peak one. So even with the higher expense ratio, you can see their 1-year return. It's a new fund, is far above the benchmark.
Sorry, can I just ask another question?
Yeah.
Going back up to the page above this one, what did you say about the JP Morgan mid and small cap that are showing on watch, but they don't have recommendations? Is that because
Those are managers where we've looked at and evaluated those. So the mid-cap manager is Jonathan Simon. He's been on the portfolio for 25 plus years. Really good manager. Where he's struggled is when markets tend to run pretty strong. He's a pretty defensive manager. So we actually feel very comfortable with him. It's a little bit understanding as to why he's struggled in performance. When the market charges, he's very, very unlikely to keep up. That's kind of his style. So he's actually performed about like you'd expect him. So we feel comfortable with that portfolio. A very similar story to the small cap value manager you have there. That team is a good, strong team. Also a little bit defensive in nature. They actually take a little bit of Jonathan's playbook in how they run their portfolio. So those are two teams where we feel like those are good teams. They're a little bit out of favor, but those are good options, and they're the options that we use.
so they're on watch, but you recommend they stay on watch, we make no change?
Correct.
Whereas these others, you're recommending changes even though they're not on watch?
Correct.
And also on page 49, you can see when the funds went on watch.
Yep.
So it will highlight the date that they go on watch. So you can see the small cap, the JP Morgan small cap, didn't go on watch until Q1 of this year.
So again, from a fiduciary standpoint, are we okay to just ride out these ones that are on watch? And, I mean, if the policy doesn't really say when we'll take action, if they stay on for so many quarters, it's just discretionary, I guess, and,
Yeah, like I said, we do that intentionally
yeah.
because there's definitely times when managers will just be out of favor and they're a good manager. And we've been rewarded very nicely in the past when we've been patient with good managers. That doesn't mean that we're always patient. There's other factors that play in, but
Dave, just a quick question. Do we need to change our investment policy then to allow us to make a change in the funds when they're not on watch and not following that policy?
I don't recall the language that's in there.
so the policy statement doesn't provide language that you can't change a
We
fund.
can't change it, but
It only provides language for when or if you want to. Here's the criteria you have to follow. So So according to your investment policy statement, all the recommendations we've given fall in line with what you currently
So
have.
it's not, since it's not prohibited, we could
Yep.
probably do it.
Yeah, every single fund we recommended meets your current criteria.
Do these funds that you recommend changes to have a revenue sharing component also?
They will.
Yeah,
The index fund will not, but Grandeur Peak will likely have, the other three will. T. Rowe Price is typically at 0.15. That's about where almost all their funds come in. And then Grandeur Peak will typically have a little bit as well.
So that's in the share class analysis on page 20, 21, and 22 for the new funds proposed.
So if you factor out the revenue sharing, would these still be the funds you would recommend?
Yeah.
If you were on a,
Yeah, the Grandeur Peak one that one's, because we don't know what that would be. They're not currently on Prudential's platform, so we don't know what that revenue share would be. We just know that they would allocate some.
Okay.
So that one is a little bit tougher, but we have a pretty good idea of where they're likely gonna be.
but if you were looking at you're not considering at all revenue sharing, these still would be the recommended funds.
Yeah, because the expense ratio, where we're evaluating all this, that includes the revenue share that they're paying.
Right.
Tyler, this Granger Peak would be a 40 hour.
Yeah. Yep.
Well, I have sort of the same concern about, should we wait till Ralph gets on board and have a chance to review it, other than the ones that maybe are on watch? Or,
I don't know, you wanna go out in glory?
I'm not sure what that would take. But, obviously you can make a motion to do what you want, but it seems like a lot of change for, reasons that aren't necessarily compelling that we do something right now, but.
Well, but we hired Soltis as our investment advisor, and I think the reason for doing that is to follow the investment advice that they provide. So I don't think it is prudent to hire a new investment advisor and let them give us their best shot and then not follow that advice unless there's a reason not to. And the only one I see that there might be a reason not to would be the Fidelity, which we just switched to. I think what I heard is Fidelity is
It's a good
one you're
team.
comfortable with
Yeah.
keeping.
We are. I mean, when that change was, when that change was already in process, we went in and looked at that manager and it met the criteria. And so even though it wasn't our top preferred manager in that space, we were comfortable with them. And we know that team pretty well. They've done a good job.
Question I have, talk to us a little bit how you'll manage all these changes, because that's my biggest concern is the perception that's going on and how we manage that process. I'm in favor of your recommendations, obviously, because you've done the work and you've got good explanations, and I think Lena's concerned about that as well. How do we manage this process so that the employees do understand? And I know you're gonna
Yeah.
have one-on-one meetings, but sometimes employees don't pay attention. They see the letter and they go, oh my gosh, what are these guys doing? They're crazy or whatever, so.
Yeah, so I would say the biggest thing that we would advocate is over-communicating to participants. And what I mean by that is when a change like this is made, you guys aren't required, but you have your 30-day notice. And that notice typically is pretty general, doesn't say a whole lot, just says, hey, these funds are being changed, but it doesn't explain to employees about why. So we would advocate, we're comfortable doing this, we've done it, we do it all the time, of drafting a supplemental communication. Because normally the notice, Prudential doesn't want us to come in and change their notice. That requires their compliance and it gets kind of messy. So we just have a supplemental that goes with it. That's a little bit more geared and written to your employees. It says, these are why these changes are being made. And we'll try and do our very best to summarize it and make it salient so they can read it and say, yeah, this is a little bit better performance and the expenses are going down. I get it. And then coupled with that, we would, you guys have had a lot going on, so we haven't had yet the chance to kind of be on site, introduce ourselves and go through that. We would want to couple that with typically before those changes happen, so they'd get the notice. Ideally, this is how it would happen. They'd get the notice, they'd get our communication. We'd then be on site.
Question on that real quick.
Mhm.
Can you do it multiple ways? Email and letter?
Yeah.
Okay.
The question I have for committee is, would it be helpful if we decide to recommend these changes to the commission, that before the commission consider them, that this employee meeting take place, so the commissioners can get feedback from the employees, if they so choose?
Can I throw a wrinkle in here?
I was gonna say, I know Kelly had something to say, I would like to.
I would like to just, is timing.
Sure.
So, you guys are talking about a lot of different things.
Yep.
So fund changes, as you know, take anywhere from 80 to 90 days, which is not a problem. But
Well, that's from the time the commissioners say yay, right?
And that's from the time we get the notice back from you that says,
We're good to go. Yep.
okay? So then that's when our clock starts ticking. And I just wanna make sure everybody's aware that if we do decide to go with that zero revenue share, fee levelization, and these fund changes, best practice is to do it all together and then communicate it all together. Now, our timing right now, because so many plans are moving to fee levelization and zero revenue sharing, we wouldn't even begin to look at be able to move you onto that platform until January 2018. That being said, all the fund changes could also go then January 2019. Because you've got, some of those are in Goldmaker,
Yep.
which is your PDIA, you'd wanna give a 45-day notice, right? So now we're backing into November. So I just wanted you to be aware that we only change fees, pricing on the quarter. So it'd be January would be our next open opportunity. And then it's about a 90-day fee change. So I would like you guys and the commissioners to consider doing it all together,
Yes.
whatever you decide to do. Because it will be one communication, working with Soltis to lay it out, so that here, all these things are changing. And it's great news, right? But you can kind of do it that way. So, but I wanted you to be aware of the timing, because it is only August.
Yeah.
We would be pushing this out to earliest January 1, January 2.
It's
Fee
a,
change, since we haven't adopted that and the commissioners haven't adopted that, would
Right.
actually
I'm
push it out
saying-
farther than that.
But it does
I do it all
play
at
better
once.
when you do it all together instead of piecing it out, because they won't understand first a fund change, then a
Right.
reduction of their fees, not reduction, but changing of
Yep.
how we account for the fees.
And it would maybe make sense to roll it out with our 2019 benefits through our informational meetings where we talk, I mean,
Well,
not in the
you have
same
them all
meeting
there.
necessarily,
You
but
know,
yeah,
the
it's,
benefits meeting fair, you have everybody standing there and everybody can be prepared to talk about it.
yeah, because as everyone knows, we've been through a whole lot of changes recently and we're trying to get things more stabilized. And so I just think, we need to think about it in terms of employee benefit plans, not individual retirement accounts, and how can we do it to sort of mesh with our normal course of business and so that employees are comfortable with it too.
Well, with that in mind, I'd move that we continue this to our next meeting. Fund changes.
Motion to continue, is there a second?
Does that give enough time, though, to?
Well, my hope would be we'd have another meeting in the near future.
Oh, not.
Yeah,
Not
so
November.
Ralph can look
you wouldn't have
over
enough time if you did it in November.
So not November
Yeah.
5th,
You'd be-
huh?
and have
You'd be
another
too
meeting,
short.
and not wait a quarter.
Interim meeting?
We just
It'd
do it.
have to be probably before the 1st of October, if I'm hearing you right. Or the commission have to act on it by the 1st of October, or pretty close.
You have it happen in January.
That'll
Yeah.
happen in January.
Right. That would be my motion.
I just wanted everybody to know the timing. I didn't-
Yeah, that's good to know.
No, thank you for,
I'm
and we would agree if you do it, our experience has been it almost always go better, do them at once as opposed to stages, because
And it doesn't bother you to come to another meeting?
if we have to, we can.
It does not.
We will be here. We recognize that these are significant changes, so.
So what are you thinking as far as the date for the next meeting?
Well, I think we need to
Early
have another
September.
meeting soon with regard to the RFP process also, which we'll
Right.
Yeah,
discuss later.
that was
So
gonna be my,
I'm thinking end of this month or first part of September,
Okay,
so not long.
I'll second the motion based on that interim meeting.
Okay, so there's a motion and a second to continue the fund change decisions until the next meeting, which will be an interim meeting held within the next month, hopefully.
No later than, we have a deadline, we have to have the meeting.
Later
by?
than maybe mid-September?
September
Yeah,
15th.
September 15th.
I would agree.
You okay with that amendment?
Yes.
Okay.
if
I'll
you guys
Okay.
wanna
second
look at
those two.
calendar and maybe send us a couple of dates that would work.
Well, I think we'll discuss later. some
Okay, okay,
date.
perfect.
Okay, all in favor, say aye. Aye. Any opposed? None, so 5-0. That will also be continued. Gonna leave it all for you. Okay, we better move along, because, yeah, our time is running out, and should we move to the prudential plan reports?
I know they're tired of hearing me talking. I'm tired of talking, Kelly, so I'm glad it's you.
Well, we don't have bad news in the plan, so probably can zip through these pages relatively quickly. So if you want it, everybody has this book? Do you?
I don't.
Do we have
You
an extra book?
If we don't, it's okay.
Let's see, I think I do have one more. Does everybody on the committee have
Say
one?
we could
Okay.
If you want to turn to page 7, we'll just, I'm sorry, page 4, start with page 4. So this is just the plan asset summary that we go over, just saying how many assets are in the plan combined. As of 6/30, it was a little over 158 million, with the largest plan, which is the 401k plan, a little over 100 and almost 102 million. The 457 plan had 33, almost 34 million, and the 401A has about 22.2 million. And then again, just the participant counts for the committee's benefit, how many people are participating in each plan. I'm just going to look at the top on page 7, just the top left balances over a 3-year period with Prudential for the 415 plan. It has grown from about 81 million in 2016 to 92 million in 2017 to a little almost 102 million in 2018. So steady growth with the plan is what we want to see. If you want to flip to page 11, this is our plan demographic summary. As you can see, things haven't changed quarter over quarter too much. We stayed pretty steady with total participants. We went down a little bit with active participants, which would correlate to going up with terminated participants. We had 2 people suspended for taking hardship withdrawals. We have an average account balance of the active participants at about 86,000, which is good. We also have participants, 516 people that are 50 and older, which is holding a little bit more than half the asset at about $60 million.
That's active and retired, or is that?
That would be everybody in the plan, yep. Just money in, money out, you can kind of see we had a little bit more contributions in. And those were participant contributions went up a little bit, so did employer. And then money coming out, we had a little bit less money coming out in rollovers. We went from almost 2% down to 1%. So that's pretty good as well. Just for the sake of time, I'll run through a couple of numbers on page 12. I know we talked a little bit about Goalmaker. We have almost 37% of the participants in the plan, the assets in the plan in Goalmaker, which is about 37.5 million. 633 people in Goalmaker, which is over 50%, about 50% of the plan also is participating in Goalmaker. So that kind of goes back to half the plan would be affected if Soltis would like to tweak the asset allocation so that you had some more exposure to different asset classes.
Sorry, is this still 401k or is this combined?
This is all K, yeah. I usually just run the K.
Yeah.
The other 2 plans are in the book, and if you'd like to take the time to kind of go through those, but there's not as much activity in that plan. Again, we have some income flex in the plan. Income flex is the guaranteed income stream product that we have. We've got 16 participants, and of those 16 participants, about 45% of their assets are in the plan, in the income flex plan. If you go down, we have a little bit of growth in Roth as well. That has gone up just a tad. And then question came up earlier today about our stable value. We have about 20% of the assets in the plan, a little lower than the Prudential book of business. There's 85 people that are in the stable value plan as a sole investment, so that's something that I guess we could maybe talk about doing an email or trying to target those people at the benefits fair. And I know, Dick, you work with a lot of those people as well. We can get a list of those people that we might want to talk to that are under, what would you, 55? Make sure that they understand what, you know, what their asset allocation is. We're moving to page 18. Employee contribution rate. We have 6% of participants with no employee contribution. I know that that's been a concern of the committee in the past because of the 6.2% match in lieu of Social Security. So that's where that number sits right now. We've got 70% of the people who are participating, but not at the full 6.2. And then we have 23.9% contributing at the full company match or more. So we've got 61.5% of the people at 6%, and then about 11% at 10% or more.
So if they're at 6%, basically, or 6.2, how can 70% not be at the full company match?
So if there's 6%, they're not counted at the full match, right?
Right.
So there's 6 or 6.1.
Well, there's
They're counted as
6% of
not-
the employees, if you look at the big numbers down below, 6% of those have no company match.
Right, but I would think at least 70% are getting the full company match. But anyway,
Maybe there's
Well, that would
6%.
tell me that the people that, all these people underneath have gone down and elected less.
one person's at
So they're
6, so it
opting
brings the
out.
whole group.
Or they're just electing down.
So they're probably at 6, it says 6%, but probably 6.
It's probably 6.2.
I think so,
Yeah.
I just,
Yeah, this is a general grid, so I think that those would be the 6.2.
So if you were to look at it, it's probably plus the 4, there's probably 14% that are not at the full 6.2.
Right.
probably.
and some of those
6
might
for-
be just new, or, I mean, just not eligible for the
Not
match yet.
eligible, yeah.
No, this would be active participants who are eligible.
Eligible for the match, well, or even what they're putting in. But-
Yeah, we wouldn't have any numbers in here of people that were not yet eligible for the plan. If that's something, Lena, you think that Ralph and I should work on, just to kind of scrub the numbers a little bit, I'd be happy to work with Carol on that.
Okay.
Looks like it's 14%. Well, it's even
Let me
less.
make a note of that.
Yeah.
It's just this group here.
We've moved to page 22. Just talks a little bit about auto enrollment. Over the quarter, we had 22 participants that were enrolled during the reporting period. We had 9 people go out and change from a default investor by changing an option, by either putting in more or less from a contribution and or changing an investment election. We had 3 people who stopped contributing during the quarter, and we didn't have anybody decline the auto enrollment prior to, so. And the thing at the bottom where it says declined contribution escalation, that's a holdover, and unfortunately, our reports are general. And remember, we put contribution escalation in, and at the last minute, we pulled it out. So the system still pulls that you have it, and I don't have a way to get it out of here, so let's just always just kind of skip that page, okay? I've tried. If we turn to page 35, there's a loan activity report. The average loan on the plan is just under $12,000. If that, you want to compare that to what the Prudential book of business is about $7,500. We have 21.2% of the population have an outstanding loan. It's significantly higher than our Prudential book of business. I'm just going to do a little commercial here. It's not anything that we have to consider, but we have started something called the emergency savings account that is utilized within the 401k plan as an after-tax savings program. If you would like more information on that, to see if you would like to be able to set aside a source of money that would be after-tax, that your employees could defer like 1% in of their salary to use for emergency savings, I can bring some information to the next meeting or send it prior to the meeting to see if you'd like to discuss it. It is something my other clients who have loans are looking at how do we bring the loans down from the plan. And it's been very highly utilized. We just started in April, and we already have about 4 plans.
It's not a Roth then,
It's not a Roth, it's just, we just use
it's like
the
a bank
after,
account.
we use an after-tax savings source to be able to record keep it for you and to be able to payroll deduct a little bit of money into it so that if, you know, the statistic is 68% of a 401k's population don't have $500 in emergency savings. So that's why they come and take out these loans, is because they just have to have the money for whatever. What happens here is you just set up an after-tax source. The after-tax source is available for them to put in 1%, 2%, so that they have some money, and then they could call and just do a distribution when they needed the dollars, instead of going into the loan system and taking a loan.
So it's after tax, so they're not paying taxes at a distribution and there's no
Correct.
restrictions on it.
Right, and what we generally see, the ones that we've worked with just use their stable value fund to be the fund that it's invested in, because it does have a minimal interest rate and it's not volatile, so they're not gonna have a lot of investment loss or gain, so there wouldn't be a lot of gain in a taxable event if they use that as an account versus, you know, something that they're gonna use for vacation or to buy their, you know, Christmas presents or whatever. It's just something that we have found trying to help through our financial wellness program, trying to help people manage their dollars a little easier. And if it's payroll deducted, sometimes that's easy. So I'll just go ahead and send the committee some information, and you guys can determine whether you want to continue to have any discussion on it. Okay? And that's really all I have. We mentioned Goal Maker, and because of time constraints, you know, we talked about as much as we really need to. So, does anybody have any questions for Prudential?
I don't know if I have questions on this, but I was wondering if you can give us a report with regard to the expense account.
Uh-huh.
With regard to whatever's, all the monies that have gone in and all the monies that have gone out
So,
year to date.
did you get that from Carol? So Carol sent it to Mark, I think. I have it. I can send it to the team on all 3 plans by month.
Yeah, if you'd copy us.
Do you have okay, so I'll
didn't
send
get
it
it.
right now.
That'd
So
be
I have
great.
it by month. I can give you the balances if you'd like to see the balances right now.
Well, I'd like to see all the, what gone in and what's come out.
Okay, yep, I have that right here. Let's see. I thought she sent it to everybody because she said team. Okay, let's see. Okay, so first plan that I have listed is 414. The account balance as of like 7/6 July, there was total activity in the plan of minus $6,311. There's let's see. So we have some earnings in there. We've got some billings for Soltis. So our ending balance was a little over 28,000 for 414. 415, our ending balance was $104,228.34 with about $31,000 of activity.
Are you still doing the 25,000 a quarter and then a true up at the end of the year in terms of contributing into these? Or is that's how it used to
I
be?
think so. Let's see, 7,500, yes, 30,000 flat fee annual, yeah. Yes, and then we true up, and then there's true up. And then the 416 plan had almost $60,000 in it with about $10,500 of total activity in the plan. And then I'll send this over to you, Tyler, as well.
Perfect, thank you.
Okay?
And will you send that to committee as well?
I'll send it to the full committee, and Lena, you have it already, right?
Apparently I do, yeah.
And I'll send it to the full committee and Tyler.
Because I'd like to see that as well.
Yep, absolutely.
Yeah, could you provide that each quarterly meeting that we have? I'd just
Sure
like
can.
to have a written document that shows.
Sure, I'll just add it to the book.
Yeah, that would be great.
I'll just add it to the book.
There was a question in the minutes about combining the plans. I think we determined we couldn't do that last time, but did you verify that for sure?
Well, I think what we found out was, when you mean combining the plans, we could combine the 401A and the 401K. You'd have to terminate the 401A. So it's not, you couldn't merge them. You'd actually have to do a plan termination, and then we'd have a separate source of money in the 401K plan. I know, Lena, you said that there might be a few stragglers. We've got about $42,000 a quarter of contributions going into the 401A, and that's where I think might hang us up a little bit.
Right, and actually I asked Lindsay to talk about that a little bit too, because some of the RFP responses address that, and I just wanted to clear up, you know, what would it take, is it doable, and then, you know, later we can decide if we want to do it or not, but maybe, I think that topic is actually on the list here, but we are going to run out of time, so, but.
Yeah, yeah, I mean, you can go through it and do it. As Kelly's mentioned, you've got to terminate the plan, and then those employees that are in that plan, you know, they've got to be communicated to, here's your options with the plan being terminated.
Their option has to be, as I understand it, that they can take the withdrawal,
Mhm.
roll it over
They can
somewhere
roll it
outside
over,
the plans.
take it, or they can roll it
or
into
they
the new
can
plan.
Roll it
But
to
they'll
the
have that option.
401K. And I think I read somewhere that we could set up a default for it to roll to the 401K if they don't make an election. Is that,
I think so.
I'm.
I
yeah,
think
I'd-
what you would
I'd
do is
kinda
we'd set up
defer
a
to
separate
Prudential
source.
If you guys allow, if you guys have them set up so they could do that.
Yeah, I'll
Or-
verify that,
or
but
they've
I
gotta-
know we've done that with other
Okay,
plans.
or they've given a time frame. Yeah.
Yeah, so they say in so many, like, 120 days, if you don't return this, your account now will be held in the 401K account
Yeah.
at Prudential. But,
Why would we not do that? It just seems like a.
well,
Because
I
there's
think
a
you
lot of
had those
assets.
the contributions, depending on if you can do anything else with those contributions for whoever are
Yeah.
getting those, I think is a
Right.
hang up.
Can't they go into the plan that you,
I don't know if we can do that, because aren't they certain not
Well,
eligible
right
for the
now,
other plans?
401A contributions are mostly coming for appointed and elected employees who opt out of the URS system.
Okay.
So we have about 20 people getting contributions. You're not, are you? Okay.
So we'd probably have to amend the document.
So, yeah, there'd have
Yeah.
to be some document amendments and so on to do that, and see where else we could put them instead. There are also some post-retired, re-employed people that I think are getting some contributions. And so those are the two groups that are continuing to get some contributions in the 401A. And then the other consideration is if you terminate the plan and everybody has the ability to take their money out, which you have to give them, then you're potentially could lose 30 million of plan assets that the county now holds in its plans, which gets you, volume discounts and bargains on
Yeah, I think
fund investments. and
if
so
you're
on.
able to put the default in there, I mean, in large part,
I was gonna say that would
you'd
help.
see most of the assets come,
Probably.
but you never know.
When you need to do, like with all the education you've already talked about,
Yeah.
we really want to make sure anyone in that plan under 59 and a half has
Yeah.
either been spoken to personally or has had mailings and whatnot, because we were talking about that earlier, is that, $20,000, you still have the penalty regardless of whether you can get at it. So, you're looking at $4,000 to $5,000 in tax implications on $20,000, which people don't,
Right, there's that.
they don't realize it till they
But
go to the
also
tax
some
man the
people-
next year. So.
Yeah, have their own financial person, they want to take the money out
Yep.
and roll it over to their own IRA and
Yep.
not
If
leave.
they roll it over, there's no tax.
Well, but
Correct.
the plan has
Correct,
lost
but
the
we're worried
asset.
about those people that just say, hey, there's
Yeah,
$12,000, I'm gonna go buy a boat,
Right.
That
The
would be,
investments are all the same in both plans.
Correct.
It's just we separate them out for record keeping and reporting and all that.
Well, and they're legally two different plan documents, two different sets of rules, and, so, yeah, there'd be some definite work to do to make that happen, but.
I'll talk to your, retirement pension consultant who works on your documents and have them come up with any, look at both the plans, make
Yeah.
sure, because you're not ERISA, you have more freedom to do some of these eligible, ineligible type things inside of a K plan. And I'll just have them look at it and just make sure that all the parameters that require, and the requirements in the A plan can come over to the K so we can
Right.
make sure everybody's taken care of.
So it's,
Are there savings what's the upside of merging?
Well, there's one less plan, so,
Right.
so
So how
Dave,
much
in your,
savings
in
is
your scenario where you want a flat fee, right? You've got one less plan that's gonna get charged $100 a year.
But would your required fee be significantly less if there were two instead of three?
It depends, wouldn't be significantly less because we communicate all together, the statements all together, right? There's not extra
That's why I'm
mailing,
wondering.
you know, because all the plans are together with at Prudential. So if someone's in, like we have 235 people in two of the plans, all of their information's record kept together. They don't get three separate statements, so,
The fee
not
would be
significantly.
charged by type of account, so if you have money in all three, you have to pay three.
That's correct.
Correct.
That was really probably my biggest concern about going to a
Merging those two, by the way.
Yeah, that was my biggest concern is those people who have a small account balance in one of the other plans, it might get chipped away, but if you have less plans, then you have less
Yeah.
fee.
Right.
and it's been really 10 years now since we've made contributions to the 401A for most employees, and so the number of active employees that have a balance is constantly shrinking, so it might be time to look at that.
Okay, well, I'll have the retirement counselor or pension person take a look at the documents.
I think that's really your first step. Have that look through your documents and determine, what steps would have to be taken to get it done. Because there is, and like I say, I think it would, at the marginal level, probably save you some fee and simplify some things. But at the same time, you got to make sure that, understand what those are, make sure those that are in it, that are contributing, that you can find a way for them to continue to be able to contribute through the new plan or whatnot. And then be aware that if you do, to make that change, you gotta terminate. When you do it, you do have to give them the options of, here's your options. You can take it, you can roll it over, you can put it back in the new plan.
So I've terminated ERISA plans before, and there's a
Yeah,
lot to it. I don't
it
know
is.
if
There is.
there's a lot less to it if it's a non-ERISA plan, but it's,
Most people run their ERISA
Yeah, I was
plans,
gonna
they're
say.
non-ERISA plans like ERISA
Yeah.
plans, so,
right, well, and that's
you know.
kind of what we've said we're doing, so
Yeah.
just be
Pretty
aware there's a
similar.
lot of work
Yeah.
involved with that too. But, okay, we're out of time and we're not out of topics, so, I had asked Soltis to do a demonstration of their one-on-one meeting structure and how that would work, because we haven't really had any of those yet. But I wonder if we should save that for the next interim meeting?
Let's do it quickly.
Do it quickly,
I'd rather-
okay.
We continue too many items.
I know. I know.
It's easy, we got the agenda ready for the next meeting.
We'll just do a quick synopsis. So what would happen in these meetings is the participant would come in, sit down. Because we have access to the Prudential account, we pull open their account. But first, we usually start off with, hey, do you have any questions for me specifically today? Or do you want to just go over your account? We'll go through their specific questions if they have any. So, because sometimes people are like, well, I forgot my password. How do I log in? Like, that's going to be a different conversation than, hey, I need help with my financial planning type of thing. Then from there, what we can do is if they do want more of a financial plan type of thing, we have a software that we can log their info in and we can help them, see their long-term plan. So it's an account aggregator that we can throw all of their, information in there and kind of give them an outlook on their total retirement success. The one thing that I think we have a lot of opportunity educational wise is the Roth. You don't see a lot of utilization in the Roth option in your plans. And so, for younger participants, especially with the new tax cut, Roth might be a more advantageous choice. And so typically in a one-on-one meeting, if they haven't brought their computer, I will have them log into their account on my computer, and then they will be making the changes themselves, right? I might be helping them, assist them in the changes, but everything has to be done through them. So I don't click buttons for them, they click buttons for themselves in the way.
But if they don't remember their login, we can pull up their account and view it just like they would, but we just can't affect any changes.
Correct.
So, we typically, we like to have them, if they can, log in. So that way, I think for the most part, when we meet with a participant, most of the time they want to do something, and if they don't, you don't help them make that change then and there, it never happens. So we try very hard to affect change in those meetings. But if they can't get in, we'll still have the ability to look at the account, review everything with them, and then even at the end of that, we can call Prudential together and kind of walk them through that.
So prior to the meeting, do you contact them and let them know what it is that they need to bring with them to the meeting?
Yeah, so typically we set up a schedule of throughout the day of how many, like time-wise, right? How many meetings, so whether they're 20 or 30-minute meetings. That's really contingent on how much time you want each participant to have. So, I mean, I have some plans that I have 20-minute meetings, some plans I have 30, some I have 15, so it just is dependent on participant needs, demand, how quickly, we get through meetings. So let's say typical, we do like 30 minutes. In those 30 minutes, we'll typically log on to their account, we'll make any recommendations, those changes, and then if we have follow-ups, then I can schedule an appointment with them over the phone or come back down, that type of thing. So it's pretty autonomous in how that we structure it, in the way that we just want them to have their overall retirement success, I think.
Okay, well, just to give some perspective on it, maybe, the kinds of things you're talking about with their Prudential account and accessing it and making changes and so on. I think Dick does that now with a lot of our participants. What we used to have in terms of our consultant was more an individualized financial planning session where they would fill out a whole set of paperwork beforehand about, are they eligible for Social Security, or what mortgages do they have, what inheritances might they get, what other assets will they have in retirement, and what does their
State
spouse
retirement-
have?
State retirement too.
Yeah, and
Yeah, correct.
incorporated URS, and so we would be thinking more in terms of a comprehensive retirement picture that, that they would prepare for, that you would prepare something for them specifically.
Correct. We have that functionality. Maybe I spoke too quickly over it. So we have an account aggregator. So we have a financial planning software tool that's online. So we don't do hard copy. So we can send them a link in advance, and they can fill it out online, and then we can create that full financial plan for them.
And when they do that, they'll actually have their own personal financial planning site that's secure, that they'll have access to all the time. That from all of their accounts, it will pull every day, update everything, and whatever we model or plan for them, it will automatically update as well every day.
Does that include state retirement? Huh?
So you can
Yeah.
add pensions in there. Yep.
How about
If you have a
Social-
financial
Social
login,
Security?
if you have
Social Security integrated as
Does that
well.
include the Social Security penalty that we're under here in the county?
We can model it
We can
with
model
it,
it with
but the original planning software.
yeah, the
wouldn't have it.
default has it in there. We'd have to override it, but we can manually do that. And
Will it
then
include the spouse's Social Security or any?
if they have it,
Correct.
yep, we can put all that in
Yep.
there.
It's fully, you can integrate outside accounts, you can integrate your checking, savings, all of that. And so, and then it's really easy because it's snapshot modeled. They can even run most of the reports or quite a few of the reports themselves as well.
It might be nice if you could demo that for this committee to give us
Yeah.
an
I
idea
was
of
gonna
what's
say,
really
set up a
there.
day and do
Yeah,
everybody on the
absolutely.
committee, and that way they'd have a
I
good
mean,
idea.
it'll be a financial side. I mean, they can access it on their mobile device or an iPad. They can pull it up at any time. And it's software through Fidelity, so in terms of cybersecurity, there's no transacting that happens, but it will. It's a planning tool that basically feeds every day. So every day it'll go out to any account that they've loaded in. It will pull the updated values and everything, and it will automatically feed it through the planning model that we've done.
Yeah,
they'll
so
be able
that's
to see
more
it
kind of what
every
I
day.
was thinking that we were supposed to be offering.
Correct, yeah, and that's definitely one thing that we go through. And then as, you have those visits frequently, right, we can update those plans or if they have questions. Also on the website, it does have kind of estate planning flow-through charts, so to help people with that issue as well.
So what kind of authorizations do you have to have it invade the Prudential site and pull your information there and
So
URS and pull information?
It's an aggregator where basically they go in and put in any account they have a financial login. They can go into the tool, enter the login credentials for that financial.
Oh, so you
account.
actually put your login credentials there.
Correct, but it's like Tyler mentioned, it's non-transactional based, so you can't move money from this side. So all it is making a daily snapshot for you, right? So the difficulties with financial plans is that we used to make one, and the day that we made it, it was stale, right? So, because it's always updating, then you have that flexibility.
So I think the contract says we're supposed to have 12 days a year of this, of financial planning, which we haven't had any yet, so I'm thinking Ralph would like to schedule 12
Which
days
was
between
on the agenda, right?
now and, no, I'm saying before we ever have another meeting, that's something that you could just do
Totally.
directly with Ralph
Totally.
to set up some times and get the word out so we can get people scheduled. And just for a point of reference, we scheduled 45 minutes apart before because of there's so many complexities with no Social Security,
Sure.
with URS, and a lot of moving pieces, maybe more than your typical client. So I don't know if you
Which 45 minutes works. That's why we.
Yeah, 20 is the kind of we have a few clients that will push for 15, but it's really tough to.
Yeah,
Again, we
that's
want
not
to leave enough
enough.
time if we sit with them and they determine, hey, I need to do this or make it a change, that we
Right.
can actually help them affect that change.
And it might depend on how close they are to retirement, whether they'd need a full 45 minutes or
Yep.
maybe. But I went a couple times and I found I could have used more than 45
Yeah.
minutes, so
And
that
then
might be the place
One
to
thing
start.
we also offer is a call center, right? So if they ever have questions and we're not scheduled to be there, right, they can call.
We have an
Soltis.
advisor line. They can call any 5 days a week, any day that market's open or off. So
Were
they can
they-
call and say, hey, I'm a Utah County employee. I'd like to talk to an advisor. And we can, over the phone, do the same thing.
And so because of how the software works, if I'm not in the office or someone else can also pull up their financial plan as well. So it's not.
Okay, but it seemed to me too that we had to maintain sort of a separation between who's advising the plan versus who's advising these individual participants.
Yeah, so we're a fiduciary of the plan. So under, we take what's called 408G2 status, which means we're a fiduciary to the plan. And because we're a fiduciary, we can advise them on what they're doing. So we can actually give investment advice as to what they're doing in their account. And if they wanted to do something outside of, the plan with personal assets, then yes, there's what's called an exemption, that disclosure that we would have them. One is anything outside of the plan would be different.
Mm-hmm.
And we would have a disclosure that says, hey, you understand this is outside of the plan. And
Okay.
so,
All right, well, we would like to schedule some days really
Okay.
soon.
Okay, perfect.
Right? Okay. All right. So it's after 5, but we need to talk a little bit about the RFP process. Would we go to closed meeting for that discussion, are you thinking? Or,
Yeah, I think so.
okay, so,
I'll move that we go to a closed meeting
For the purpose of
for discussion on item number 7. Is it 7? 8.
discuss the professional competence of an individual or individuals.
Exactly.
That's what I thought. And I second that motion.
okay, we have a motion and a second to go to closed session to discuss the RFP process, the professional competence of an individual or individuals. All in favor, say aye.
Aye.
Right.
Any opposed? None, so let's do that now. Can Ralph stay for it or not really?
Pardon me?
Can Ralph stay?
Yes, you can.
yeah.
Yes.
So we'll excuse anybody who's not,
This part will not be recorded.
yeah.
Yes.
Thank you, Kelly.
Hey, thanks, Kelly.
See you, Cal.
We'll touch base with you on a few of these.